Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. National Financial Literacy Month is celebrated in April, which is a great opportunity for us to check and promote our financial situation and skills. Joining me for this segment, we have Kristin Myers, Editor-in-Chief with TheBalance. And for this segment, we're going to discuss tax tips for investors. Kristin, it's great to have you back with us at MarketSite. And let's start with our first topic here. And capital gains, how are they treated on investments?
Yeah, so capital gains is essentially the money that you're going to make when you sell one of your investments. Now you have to consider whether you've held that investment for a short period of time, so less than a year, or longer than a year when you're going to have long-term capital gains. Now if you've only held on to that investment before you sold it for a short period of time, it's going to be taxed just like your regular income. But if you have long-term capital gains, it's going to be taxed at 0, 15, or 20% depending on your income. So you get a little bit of savings by holding on to that investment longer.
And what about the differences between tax deferred and non-tax deferred investments?
Right, so the tax deferred investments is typically what you're going to see with a lot of your retirement accounts, like a traditional 401k, a traditional IRA, and that essentially means that you're going to be taxed in retirement when you do start pulling money out of that account. It's going to be taxed like your income. Now, if you're paying taxes on it now, for example, that's non-tax deferred, it means that you're not going to have to pay taxes on it later. So just a little bit of difference in those accounts.
Tell us about tax harvesting.
Yeah, so essentially when you sell something for a gain, you might want to, let's say, cancel out that gain. And so what you're going to do is you're going to sell something for a loss. So that's that tax loss harvesting. Now you just have to make sure, however, that you're matching up those gains and those losses equally. So if you sell something for a long-term capital gain, you're going to have to sell a long-term asset for a loss. Same on the short-term side. Now, if you do that, you have to make sure that there is this thing called a wash sale rule. And that essentially ensures that if you do sell something for a loss, you cannot buy it again for at least a month. And not just you, but also your company and even your spouse, Jill.
All right. Appreciate the insight as always, Kristin. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.